You know, in any market, some companies just seem to fly, while others struggle. But what happens when things get really tough? When the economy takes a nosedive, what's the one thing that really separates the survivors from the ones that go under? Well, today, we're going to look at one powerful number that answers that exact question. Which companies are actually built to last? Let's get into it. All right, I'm going to start with something that sounds a little crazy. Google is basically a bank, and your phone company? Well, it's pretty much broke. I know, it's a bold statement. But just stick with me here, because by the end of this, you'll see exactly what I mean. And I guarantee it'll change how you see some of the biggest companies out there. Think about it. When a recession hits, all that talk about revenue growth and who's popular, it just kind of fades away, right? A much more basic question comes up. Who actually has the cash to make it through? What's that one single number that can tell you if a company is a fortress or just a house of cards?
Well, that one number is what we're calling the Fortress Index. And you can really think of it as the ultimate sleep well at night score for a company. It's this single, incredibly powerful metric that cuts through all the noise and tells you who's in control of their own destiny and who's basically owned by their bankers.
So what is this magic number? It's the cash-to-debt ratio. It's actually super simple. You just take a company's cash and you divide it by its long-term debt. Now look, no single number tells the entire story, of course, but this one gets you incredibly close. Here's why. Revenue tells you how popular a company is, but cash tells you if it can survive.
So we've mapped out this Fortress Index for a bunch of major companies, and wow, the difference is just stark. On one side, you've got the fortresses in green. These are the companies with way more cash than debt. They call the shots. On the other side, you've got the fragile companies in red. They owe way more than they have. Their fate? It's completely in their bankers' hands. Okay, so let's start with the good news. Let's talk about the fortresses, the companies sitting pretty in the green. These are the businesses that have a massive financial cushion, the ones that are truly built to weather any storm.
Right at the top of our list, you've got Palo Alto Networks with a just staggering 12.8x ratio. Let that sink in. For every single dollar of debt they have almost $13 in cash just sitting there. As a huge cybersecurity company, their business is software, so they have low overhead and cash just pours in. That, right there, is the definition of a financial fortress.
And who's right up there with them? Google, with a ratio of 9.2x. And this brings us right back to that hook from the beginning. Why is Google like a bank? Because it is absolutely swimming in cash. With almost $10 in cash for every dollar of debt, it operates from a position of almost unimaginable strength. So here's the really crucial point. These companies aren't just resilient. They're what you might call anti-fragile. A market crash doesn't just mean they survive it. For them, it's a massive opportunity. While all their weaker competitors are begging for loans just to stay afloat, they can go shopping and buy up entire companies for pennies on the dollar.
Now, I know what some of you are probably thinking. As you look at this green list, there's one name that probably jumps out at you. We hear about it constantly. Production targets, fierce competition, the stock prices all over the place. So, isn't Tesla supposed to be risky?
Well, let's just ignore the headlines for a second and look at the actual numbers. Tesla's cash-to-debt ratio, it's 6.3x. That means they have more than $6 in cash for every $1 of debt. The headlines are telling one story, but the balance sheet, that's telling a very, very different one.
And that's really the bottom line here. While the critics and the headlines focus on this narrative of risk, the balance sheet tells you the truth. Tesla is a fortress. It has more cash on hand relative to its debt than almost any other major industrial company on the planet.
All right, we've seen the fortresses. Now it's time to cross over into the danger zone and take a hard look at the companies living on the financial edge. These are the businesses whose fates are tied not to their own cash, but to whatever their lenders decide to do. And the contrast couldn't be more clear. The fortresses are cash-rich, and they are masters of their own destiny. The fragile companies are debt-heavy, and their focus isn't really on innovation anymore. It's on just making those huge interest payments to their bondholders. They're working for the bank.
And this is actually where a lot of investors can get into big trouble. It's a little something called the yield trap. You see a company paying out a big, juicy dividend, and you think, oh, that must be a safe, stable investment. But so often, that attractive dividend is just a mask for a really dangerous situation on the balance sheet. Which brings us to AT&T and Verizon. Their Fortress Index score, it's basically zero. Their long-term debt is so massive, it completely dwarfs the cash they have on hand. And this brings us to the other side of that hook I mentioned at the start. So what does a ratio of 0.0x actually mean in the real world?
It means these companies are carrying billions and billions in debt with almost no cash to cover it. It means when interest rates go up, a massive chunk of their profit is just eaten alive by interest payments. It means they're not really working for the shareholders, they're working for the bondholders. And that's why, from this perspective, your phone company is broke.
We also see another really interesting pattern emerge over here in the red zone, something we'll call the mover's burden. This applies to companies whose main business is moving a massive amount of physical stuff around. Atoms, not bits.
Just look at the comparison here. You've got companies like CVS and Cardinal Health with tiny ratios of 0.2x and 0.1x. These are giants with this immense physical footprint of stores and warehouses and supply chains. Now compare that to an asset-light tech fortress like Google at 9.2x. The difference in financial flexibility is it's breathtaking.
And this really gets to the heart of why they're so vulnerable. To build and maintain all those stores, all those warehouses, all those supply chains, to move that many atoms, you have to borrow enormous amounts of money. It means they are constantly operating on a razor's edge with almost no cushion if things go wrong.
So we've seen the good, the bad, and the very, very indebted. What does all this mean for you? Well, it really all boils down to one simple, powerful rule that you can use no matter what the market is doing. Here it is. In a bull market, when everything's going up and to the right, it's okay to focus on the income statement, things like revenue and profit growth. But in a bear market, when it's all about survival, your focus has to shift to the balance sheet, because that's where you find the truth about who's really built to last.
Okay, so we have a really clear picture now of financial survival. But, surviving is one thing. Actually thriving is something else entirely. A company can have all the cash in the world, but if it's not using its resources well, is it really a great business? This leads us to one final huge question. We know who can survive, but who is actually the most efficient?
And that's exactly where we're headed next time. We're going to dig into the ultimate metric of corporate performance, efficiency. We're going to find out which companies make the absolute most money for every single person they employ. And I promise you, the results are going to be a surprise. See you then.